Good morning, everybody. It's a little after 10:04. My apologies for making you wait. A little bit of technical issues this morning, but we solved them really quickly and got things together for you. So we did not have a webinar last week, but we had a lot of activity last week. So last week we wrapped up the second in our series of the Changing World of Retirement Planning online class. Many of you joined us for that class, and I appreciate you being there. I always have so much fun with the questions and the comments, and even on the online format. It's really great. And I hope you enjoyed our questionnaire that we created for the class. There's a lot of true and false scenarios on that questionnaire, and it was really interesting to receive that feedback. So appreciate that as well. In today's weekly webinar, we're going to go over our usual routine, and that is we're going to have some updates from the Slott group. You all know, but I'm going to say it again, that I'm really fortunate to be part of the Ed Slott Master Lead Advisor group. I just was chatting with Andy Ives, who's one of the authors of some of the material we're going to talk about this morning. As I was driving into the office this morning, Andy and I were chatting for about 20 minutes or so about a few different issues. So we're going to go over those updates from the Slott group, and then we're going to talk about the markets a bit. Really challenging time in the world right now. A little bit surprised that we're not seeing more of an impact in the markets, but the markets always surprise me, sometimes positively and sometimes negatively. And then after we review the market updates, we're going to do our Financial 15, which is our financial planning topic. And today continues a 4-part series. And today's part is about IRMAA, or Income Related Monthly Adjustment Amount. That is an amount that you have to pay when you start receiving your Medicare benefits, and then not exactly when you start. And that's one of the big surprises. You know, the format for this Financial 15 is things that I find in talking to advisors around the country, or people that come to me from all around the country who are surprised. And they say, geez, if I would have known this 10 years ago or 5 years ago or whatever time ago, I could have fixed these issues, these critical items that can have a significant impact in my retirement plan and in my comfort in my life and my effectiveness and efficiency in my retirement plan. But you all are learning this now, so that's good. You can correct these things. So we're going to go over today IRMAA, and that's one of the big surprises that people have in their retirement plans. Okay, so first thing I'm going to do is I'm going to share my screen here, and I'm going to read Sarah's letter or article from last week, and that's how to lose an inherited IRA and gain a big tax bill. And Sarah writes, did you inherit an IRA from someone who is not your spouse? So we talk about this a lot. I'm going to just go off the letter for a second, because what I'm seeing a lot of is that many of you come to us, and as part of your asset mix, you know, we put it all on the board, either live here in the office or on the whiteboard on the computer, and we break down what buckets your assets are in: your taxable bucket, tax deferred bucket, tax free or tax advantage bucket. And these inherited IRAs sit in these tax deferred buckets, and we can't do our options are limited with these. You can't do Roth conversions. You can do some charitable contributions and things like that, but our options are really limited. So wouldn't it be great if we could have some planning before you inherit these kind of difficult things to deal with that could really mess up your retirement plan, that from a tax efficient point of view? Always nice to inherit money, but we want to make sure it's done the most efficient way. And we certainly don't want to pass on the problem to our heirs. So did you inherit an IRA from someone who is not your spouse? This is not uncommon. Maybe you inherited from a sibling or a parent or a friend. If this is your situation, proceed with caution. For non-spouse beneficiaries, a wrong move can result in disastrous consequences. So take your time and do it right, Sarah says. Your first step is to contact the IRA custodian to be sure that the account is properly titled as an inherited IRA. Really good point. Next, carefully explore your options. What are a non-spouse beneficiary's options when it comes to the inherited IRA? So we're talking about here non-spouse beneficiaries. Spouses have some entitlements that others don't. In the wake of the Secure Act, most non-spouse beneficiaries can no longer take advantage of the Stretch IRA. Only eligible designated beneficiaries, EDBs, have this option. Non-spouse EDBs include disabled and chronically ill individuals, as well as minor children of the IRA owner and beneficiaries who are not more than 10 years younger than the IRA owner. However, non-spouse beneficiaries who are not EDBs are not forced to take a lump sum distribution. Instead, most non-spouse beneficiaries will be able to spread distributions from an inherited IRA over a 10-year period. Annual RMDs may be required during the 10-year period if the original IRA owner died on or after the required beginning date. The IRS has waived those payments within the 10-year period for years 2021, 2022, and 2023 due to continued confusion over the rules. That is really their self-imposed confusion that the IRS has, but we appreciate the latitude of not taking these required minimum distributions, the comfort in not having to take them, because it's been a very confusing time with guidance or lack thereof, or confusing guidance from the IRS. Lack of guidance would be better than the confusing guidance we've received. So when you inherit an IRA as a non-spouse, you should proceed with extra caution. Touch nothing is good advice. Be aware of all your options and give serious thought to what you want before doing anything. A non-spouse beneficiary who takes a distribution without understanding the tax consequences has no remedy. There's no undos here. The IRS doesn't say, well, geez, we understand that you're not an expert. You didn't know the rules, and we'll let you do it. And even if you are an expert and you make a mistake, they don't let you undo that either. You've probably heard me talk about it because I talk about it in class a lot. Famously, I had a very good estate attorney call me one time, and she said, I need help administering an estate and distributing to the beneficiaries. And it was in an IRA, but she said, Fidelity helped me open an estate account and transfer the funds to that. Well, what she's just done is created a taxable event for everybody in that year. And she didn't, there was a long pause on the phone when I brought it to her attention. I did it as delicately as possible. But she said, how do I fix it? And I said, you can't fix it. It's done. And that's the fact. Once these mistakes are made, very few mistakes can be fixed. There are some out there, but not typically when it comes to inherited IRAs. I don't know of any fixes for inherited IRAs. A non-spouse beneficiary who takes a distribution without understanding the tax consequences has no remedy. That's where I was. A non-spouse beneficiary, unlike a spouse beneficiary, does not have the option of rolling over an unwanted distribution. Non-spouse beneficiaries do have the ability to move an inherited IRA to a new custodian, but the move must be done via direct trustee to trustee transfer. So you can't take a 60-day rollover and put it in your checking account and decide what custodian that money is going to go to within 60 days. It doesn't work that way with inherited IRAs. It has to be a direct trustee to trustee transfer. And here's an example. Ben died in 2023 at age 65. He named his two daughters as beneficiaries of his IRA. Daughter Gail consults with a financial advisor and sets up an inherited IRA. She does not take an immediate distribution from this IRA. There is no taxable event. Instead, Gail must empty the inherited IRA by December 31st, 2033. Gail's advisor sets up a strategy for taking distributions from the inherited IRA over the next 10 years, taking into account the rest of Gail's expected income each year to maximize tax savings. Now, Gail didn't, let's be clear about something. Ben died at age 65. He had not reached his required beginning date, so Gail didn't have to take distributions during that time. But working with her financial advisor, she decided that it made sense to take distributions instead of just waiting until the 10-year period. There is flexibility there. Now, if Ben had been age 75 when he died, would Gail have to take distributions during that 10-year period? I'm going to leave that hanging out there. Answer that question for me on the chat. Good morning, Doug. Good morning, Keith. Good morning, Jerry. Good morning, everybody. Answer that question, please, on the chat. So the question is, if Ben had been age 75 when he passed away, would Gail still have the flexibility of not taking distributions during that 10-year period, or would she be required to take distributions during that 10-year period and fully empty the account at the end of that 10-year period, which would be December 31st, 2033? So you can go ahead and answer that question. Daughter Nicole does not consult with an expert and takes a large lump sum distribution from her inherited IRA. Nicole will be faced with an immediate large tax bill, reducing her inheritance. There is no remedy for Nicole If she has second thoughts, the distribution cannot be rolled over. Nicole has lost her inherited IRA and gained a tax bill. And that might be fine for Nicole if that's what she wanted to do, but most people don't want to do that. Non-spouse beneficiaries and Roth IRA distributions, today's Slott report mailbag. And Andy, our friend Andy Ives, answers this one. And Andy this question comes in on September 6th in a piece titled Rules for Inherited IRAs That May Surprise Non-Spouse Beneficiaries. Sarah Brenner from Ed Slott and Company wrote, if you inherited the IRA funds in 2020 or later as a non-spouse beneficiary, you will most likely be subject to a 10-year payout, possibly with annual RMDs during the 10-year period. So this addresses the question that I just posed to you folks. My brothers and sisters and I are non-spouse beneficiaries, and my understanding is that there is no rule or code yet that states we must take some out of the inherited IRA account each year, only that it must be drained by the end of the 10th year, that it must be drained by the end of the 10th year as required by the Secure Act. My sibling says we must take some each year. Which of us is correct? We're really wading into something there. We are all under the RMD age in our 60s, and our parents passed September of 2022. With thanks, Jim. So let's see how good our students are. Well, we're at 100% so far. So Keith and Doug both say yes. And if you thought yes to the answer to that question if Ben died at age 75 and Gail inherited those funds, then yes, you would have to take distributions over that period of time. That's the same thing Jim is asking here. Jim and his sibling are conflicted on this because it's confusing. The clearest and the best way that I remember this is after I heard Sarah Brenner up on stage at one of our training events when she said, think of the Rolling Stones, start me up, I don't stop, or start me up, can't stop. Once those RMDs start, once you're beyond your required beginning date as an IRA holder, your heirs then have to take required minimum distributions as well. If you haven't started, then they don't have to take those distributions. They can wait until the 10th year. Regardless of whether you have to take distributions over that 10-year period or you don't have to take distributions over that 10-year period, the funds still have to be depleted at the end of the 10th year following the year that you pass away per the Secure Act. All right, let's get into Sarah's answer here. On February 23rd, 2022, the IRS issued proposed regulations taking the position that when death occurs on or after the required beginning date, a non-eligible designated beneficiary, and yes, that's a good clarification to what I just said. We're talking about non-eligible designated beneficiaries, which is probably most people who inherited IRAs who are not spouses. A non-eligible designated beneficiaries like you and your siblings must take annual required minimum distributions and empty the account under the 10-year rule. The rule requiring annual RMDs when an account owner dies on or after the RBD is sometimes called the at least as rapidly rule. The IRS's interpretation of the Secure Act is still debated. In fact, while this discussion continues, IRS Notice 2022-53 and Notice 2023-54 waived penalties for missed 2021, 2022, and 2023 RMDs within the 10-year period. While we wait for the final regulations, which could take many years to finalize, we follow the proposed regulations, which require RMDs within the 10-year period for certain beneficiaries. And that's the right thing to do. Folks, you could play this fast and loose and say, hey, they're only proposed regulations. We can not take distributions, but that would not be a wise thing to do. I remember, I don't remember the exact details, but there was one issue. I remember Ed talking about this, and I don't recall if it was with you folks or just with me personally. There was proposed regulations that lasted 10 years or more. And I don't even think it was, I think it was the regulations or the law was actually rewritten and the regulations were never actively answered. But this is not something that you're going to want to mess around with. And it's unlikely that the IRS will continue to forgive these distributions, probably even going forward. It makes sense. There's not a lot of logic in the tax code, but logically it makes sense that they forgave RMDs for 2023 because we were still getting some clarification on that. But it could happen again for 2024, but again, I wouldn't count on it. And don't forget, you don't have to take those distributions until the end of the year. So if you want to kind of see if it works, and if you don't have to take those distributions, and the IRS is going to forgive 2024, Don't jump into it in the beginning of the year. Next question. My wife wants to contribute. My wife wants to contribute from her compensation for her job to a Roth IRA. Does she have to wait 5 years to touch her contributions, or can she access them whenever, if necessary? I'm not talking about the earnings in the Roth IRA, only the contributions. So this is a really common question too. And this relates to the ordering rules. So I did a whole video about this with Roth distributions. So we talked about Roth contributions, we talked about Roth conversions, and we talked about Roth distributions in 3 different videos. So I may link that to the description here when we do the recording. I'm kind of saying that out loud to give myself a note. Let's link that to the description when we do the recording. So wife wants to contribute from her compensation from her job to a Roth IRA. Makes sense. Does she have to wait 5 years to touch her contributions, or can she access them whenever, if necessary? I'm not talking about the earnings in the Roth IRA, only the contributions. Good question, Dave. And I know you guys know the answer to this, but we're going to talk about it anyway. Dave, let's bring you up here. Based on strict Roth IRA distribution ordering rules, contributions come out first, then Roth conversions, then earnings. These ordering rules apply across all a person's Roth IRAs, regardless of how many exist and where they are held. Be aware that the IRS views all of a person's Roth IRAs as one large bucket of money. It does not matter if the individual thinks of their accounts as my contributory Roth and my converted Roth. Within that combined Roth IRA bucket, the owner always has access to the Roth IRA contributions, tax and penalty free, regardless of age. Conversions are a different story. It depends. It's very age dependent, but that is a really good point. So those ordering rules are contributions first, conversions second, and then last, any withdrawals are considered growth. Now, here's the thing. Be cautious about withdrawing contributions or conversions, because you can't get that money back in. If you withdraw those, let's say you've built up $50,000 worth of contributions, and you say, I need $50,000. I want to buy a car. My, the Roth, for whatever reason, seems to be the best place for you to take it, but you want to then put that money back. If you don't meet the contribution requirements, earned income below certain income thresholds, you won't be able to put that money back into the Roth IRA, absent a 60-day rollover. And the rules are very tight about that too. So it's always good if you have these thoughts. And we have clients, people who have attended these webinars and classes, and sometimes they say things that are contrary. They'll have thoughts that are contrary to the best interests of their plan and their situation. So they'll come to us and say, hey, I want to buy a car. And geez, the Roth IRA has done really well this year. Why don't we take the money out of there and pay for that car? Well, from an investment point of view, that might be a good answer. From a tax point of view, it may not be. So you want to explore these things with your qualified financial planner. And you see here, I keep this note. I've shared this with you before. I keep this at the bottom of my notes here. There are 5 classes of eligible designated beneficiaries. We talked about them a lot a few minutes ago. Surviving spouses, minor children of the account owner, disabled individuals, very strict rules around disabled individuals, the chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. So you might want to just, I don't know, if you're really into it, you can write it down, or it's gotten better, but it's not yet soaked into my brain. So I keep notes around. So I remember, I remind people I can't remember every little detail, but I'm really good at remembering where to go for things. All right. Well, that is the slot report for today. So let's go back and talk about the markets. So a lot of market activity last week, a lot going on in the world. I'm really surprised. I'm going to come back to an analyst report, but first I'm going to just share with you the market activity ending October 13th, Friday the 13th. The Dow Jones Industrial Average was up 0.79%, just slightly. The S&P 500 was up 0.47%. The NASDAQ was down really slightly, 0.18%. The MSCI World Index, ex-US, so the globe, not include every large company around the publicly traded large company around the globe, minus the U.S., was up over 1%. Emerging markets was up 1.52. Surprisingly, most indices were up or slightly down. Why do I say surprising? We're going to talk about some of the news that we had last week. But the big one is we've got a significant conflict going on in the world, right? And I'm not going to weigh in my opinion about it, but it is now, we've got Russia and Ukraine, we've got Israel, we have a lot of other hotspots in the Middle East acting up. So I'm always surprised that the strength of the market in difficult times. So that's a positive thing. We should be happy about that. Bonds were up last week. The aggregate bond index 0.95%. The 1 to 3 year index was up 0.18%. Year to date, the aggregate bond index, so that's about that 7 to 9 year maturity period, is still down 1.43, and the 10-year Treasury came down from 4.8% at the end of, the week ending October 6th, to 4.61. So again, that's the wrong way to go from an inverted yield curve perspective and an economic outlook, but doesn't seem to shake the markets. Also, we had some surprising inflation. So the consumer price index was higher than expected, 0.4% month over month and 3.7% year over year. Core inflation, which excludes food and energy, was up 0.2% for month over month and 4.1% year over year. So it seems to be inflation, although it's higher, seems to be moderating a bit, but still is higher, which means we expect that interest rates will continue to rise from the Fed. This week we have retail sales, we have industrial production, housing starts, and leading indicator index. So it'll be, we'll just see what happens with the week. But listen, as you hear me say all the time, we want to pay attention to these things, and as investment experts, we look to take advantage of where we can make our clients extra money in their investments, protect what they need in the short term, and maximize what their growth can be in the longer term. Different analysts have different ideas. You've heard me share competing analyst reports. Nobody thought that we would be, let me just go back to the year-to-date number. Nobody thought coming out of last year, and just remember how difficult 2002 was. 2022, just remember how difficult 2022 was. But nobody thought that the S&P 500 would be at 14.17% sitting here at the end of Friday, October 13th. NASDAQ almost touching 30% still, even though it's come down a bit, 28.94. If I would have taken a poll on this call or any call around the country, and I would have said, do you think that the S&P 500 is going to be at 14, almost 15%? I think that most people would say no. More in line with maybe the Dow Jones Industrial Average, and that year to date is 3.29. So it is surprising, but these are good surprises. But how do we prepare ourselves for this? Well, first of all, you let your plan drive your investment decisions and your investment allocations. And your strength, your foundation comes from not trying to keep up with, well, this analyst says to overweight whatever. We see that from BlackRock. We're overweighting stocks, we're underweighting bonds, or we're going the other way, and we're overweighting certain areas around the globe, or we're focusing on these areas of the globe. Sometimes that works, sometimes it doesn't. I found in my experience that it works less than it does. But what you want is that foundation. You want that foundation of, okay, I know how my investments apply to my plan, and you can only do that if you have a true financial plan. And where my funds are coming from in each part of my life. And that's what gives you the comfort to be able to enjoy your retirement, and also the comfort to be able to see some growth, take some risk later in life when you've got 8, 10, 15 years, you can invest in more aggressive items before you need that money. But we want to be able to count on the funds that we need in the short term and have those in very safe money markets, short-term bonds. We're very lucky that we're getting the rates we're getting in a 6-month U.S. Treasury right now at 5.55%. It's outrageous and it's wonderful. Let's take it. It can't last forever. But that is what I'm talking about is account segmentation. You've heard me talk about it. You've got to have your accounts segmented so that you know exactly where those funds are coming from. And yes, they have to be separate accounts. So psychologically, account number 3987 is funding, for an example, is funding my next 3 years. And the account that comes after that funds the next 3 years, and it all has to cycle down. So I know I'm sounding a little bit like a broken record, but this is what gives you that foundation. Add in principal protection, and of course, when from the account segmentation comes good, efficient asset allocation. You can't just you can't have principal protection and account segmentation and rotten asset allocation, because then you're letting money fall out through the cracks, and we don't want that. All right, off my soapbox. So now I said you have to start with a financial plan. So let's talk about financial planning. And here we are. Okay, so now it's time for our Financial 15. So the Financial 15 is the last 15 minutes or so of my weekly webinar. And the first part of the weekly webinar, we talk about IRA distribution rules and things to pay attention to, and great information we get from the true IRA experts, Ed Slott and his analyst team. And how to avoid those mistakes. We talked a few minutes about the markets, what the market performance was, what to look out for this week, and some analyst reports about what we think that the market is going to be, or what we should be paying attention to. And then we go into our financial planning topic. So if you're just joining us for a financial planning topic or a Financial 15, and you haven't already subscribed to our YouTube channel, please hit the subscribe, like, and notification button. And if you want to contact us, you can do so by going to our website at attleborowealth.com. That's attleborowealth.com. If you have questions for us or would like to schedule a appointment to see me, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com. And if you're one of our dear clients, you don't have to just email us. You can email us, but you have a scheduling link, or you can call us, and we'll make sure that we get you in as quickly as possible. So let's dive into the Financial 15. So this is part 3 of a 4-part series. Part 1 was the true cost of retirement expenses. Most people, we reviewed this, most people underestimate their expenses in retirement on a variety of levels, but one of them just is their general expenses, what they're going to spend on, food, fun, their medical expenses. We've talked about medical costs in part 2, but just their general retirement costs. Most planners, they ask you what you want to spend during retirement. You say $7,000 a month or $10,000 a month or so much a year. And that's what they put into their plan document without spending the time to really go in and shake the trees. You've got to shake those trees, because my experience is that most people have a pretty big difference in what their actual expenditures are and what their assumed or their perceived expenditures are. And some people will really fight you about that. But and I shared some of the tools that we use to uncover those expenses. Part 2 was medical costs after Medicare. And IRMAA's kind of part of that, but IRMAA deserves its own discussion. That's why we're talking about that today. But medical costs after Medicare, out-of-pocket costs, other costs that you have, and the national average, actually the area average, national average is probably closer to $6,000 a year. So I'll just use that. Many of you listen from around the country. So about $6,000 a year for an average healthy individual is what Medicare tells us. A healthy individual spends out of pocket for medical costs after you start receiving your Medicare benefits. So that's really important, because if you're married, that's about $12,000 a year that you may not be planning for. And these are the things that can surprise you, and these are the critical items that maybe if you had known differently in the past, you would have made different decisions about how you're planning for your retirement. But we hope to bring these things to you so that you can plan for an effective and efficient retirement and a comfortable retirement. And then today, that brings us to part 3. This is one of the biggest surprises I hear from people. And they say, I knew about Uncle Sam. We talk about taxes. Everybody knows about taxes. We're going to talk about taxes next week. Most people have a different view of what their tax rates are going to be, but I'm going to let that go to next week. But everybody knows about their Uncle Sam, but few people know about your Aunt Irma until it's way too late. So we're going to talk about IRMAA, and IRMAA is the income-related monthly adjustment amount. Income-related monthly adjustment amount that is assessed to your Medicare benefits as a surcharge. And one of the big surprises that people find is that it's a 2-year look back. So it's from money you earned and distributions you've had, your modified adjusted gross income, looking back 2 years. That's how you're assessed today. So that is a shock for people because you can't fix it for sure. You really have to do some long-range planning. I'm going to show you how you can do that to reduce or avoid it. So I've got some questions here. So what is IRMAA? We talked about that. That is income-related monthly adjustment amount. That's the amount of money that is tracked, or excuse me, that's the assessment that's tracked depending on your modified adjusted gross income. And then how is it calculated? So the best thing that you can do, and let me pull this down. So here's our website, attleborowealth.com. Again, that is attleborowealth.com. If you go into this education and resources, let me just clear that. Go into this education and resources and go to the slot corner. So that's everything Ed Slott. So I'm opening that up. So you've heard me say this before, but there's some really good information in here. There's a couple good videos. Here's a picture of me and Ed. So watch these videos. So this is a video Ed did for me a bit ago. And this is a webinar of Ed and I. And then this is what is a member of Ed Slott's Elite Advisor Group. You should watch that. That's good. But if you go down here to download free tax planning materials, we're going to be focusing on the gray form that's going to scroll up here in a second. This one, and that's the 2023 Medicare planning chart. But you put in here, it's going to ask for your email. That's okay. And we'll get notification that you download it. And if you're not already on our email list, then we'll get you on your email list. And if you want to join our email list, just download these things or send me an email and we'll get you on our email distribution list. And you'll get these recordings sent to you. But you can access these charts. So let me get this off of here. Okay, so let's look at this chart because we're going to talk about how this is calculated. This is really important, folks. So this is for Part B and Part D charges. So it shows here that I'm just going to kind of move along and highlight this. So we're looking at modified adjusted gross income. So here we go. That's what I was looking for. So the standard premiums of these, I'm just going to read this paragraph to you. The standard premiums for these charges are increased by surcharges imposed on upper income individuals, those with modified adjusted gross income exceeding $97,000 for an individual return and $194,000 on a joint return. I want you to remember that because, I had a conversation coming out of the class that the online class that we had last week. I had a conversation with a fellow who was he was a CPA and he had things very, very together. And he said to me, one of the things that really stuck with me out of the class, he said, I never even considered the effect of one of us passing away on our standard deduction. So what does that mean? Well, not unlike IRMAA, you've got, married filing single, married filing joint. These thresholds that I'm going to go over with you are much different. So when one of you passes away, and if you're fortunate enough to be in retirement with someone, your spouse, assuming someone you love, your spouse, one of you is going to go before the other. And as soon as that happens, there's a lot of baggage and stuff around that, but it's certainly, you're greatly affected from a tax point of view. And one of the effects is your standard deduction is cut in half, right? So any deductions you have, if you're claiming your standard deduction, which most people do during their retirement, gets cut in half. Your IRMAA charges come much more quickly because they start at $97,000 compared to $194,000. And your tax rates go up because your income amounts trigger higher taxes at lower levels. So a lot of bad things happen from a tax point of view when one of you passes away. So this very learned and researched and very bright individual said, I just didn't consider that. And that's not an intellectual issue. It's because it's hard to consider our own demise or the person who's closest to us. So there's definitely other things at work here, folks. But let's talk about these thresholds. So we're talking about Part B and Part D. So if you downloaded this chart and read through it, if you're concerned at all about Medicare, IRMAA surcharge on Medicare, you should definitely download this and read through it. And if you wanted to go through it individually, schedule time with me, and I would love to do that. So let's look at where we are today. This is 2023. Now, mind you, these surcharges are for income from 2021. So when 2023 income is assessed, we're going to be looking at charts at 2025. I hope you're seeing how difficult it is to plan appropriately for IRMAA, because what's the inflation rate going to be? Somebody might say, well, a good standard inflation rate is 3%. Who knows? 3.5%? Well, who knows? The Fed wants lower, right? Well, that might be reasonable. There are certainly some projections we can make, but just like anything, it's not a guess. I mean, but it's certainly challenging with IRMAA. So we work with what we have today. So let's talk about what we have today. If you're a single filer and you make less than $97,000 in modified adjusted gross income, not taxable income, modified adjusted gross income, and that's adjusted gross income with some add back on. And that was another, tax issue. They said, okay, we have adjusted gross income, but that's not enough. Now we're going to have this modified adjusted gross income, and there's some things added back in after adjusted gross income. So if your MAGI, people call it, or modified adjusted gross income is more than $97,000, well, you have a surcharge. So let's look at this. So I'm going to make this a little larger so you can see it. Make sure that I'm not blocking it. So here we are. Let's change our pen color so you can, I'm going to highlight it. Over $97,000 to $123,000 for a single filer, and over $194,000 for a married couple. They start adding these surcharges. Part B is $65.90, and Part D is $12.20, and for your total charge of $78.10. So your base premium is goodness gracious, $164.90, and then you have to add on to that. So it adds on to that. So you might say, okay, that's not bad. Now remember, if you're a married couple, that is times 2, and that is every month. Now, and it's a cliff, folks. So once it's not like your taxable income where 10, 12, 22, 24, you pay some income at 10, some at 12, some at 20, 24. The IRMAA doesn't work like that. Here's let's just say you're a married couple, and here's your $194,000 of modified adjusted gross income. Now, what if you just earn $1 more? $194,100 of a modified adjusted gross income. Well, you've gone off the cliff. Now for you, that's $64.90 more per month. If you're married, that is times 2. If you're single, this cliff is not at $194,000, it's at $97,000. So if you make $97,000 and $1, that should be $1. $194 and $1. you go off that cliff and you have to pay this more. So $65.90 may not be bad, but how about $164.80 every month times 2? And then $31.50, add $31.50 onto that times 2. How about $263,070 times 2, plus another $50.70 times 2. Total surcharge, $314,000. So here's where people get in trouble. This is kind of a sweet spot here, so I want to focus on this. People come to me and they say, well, I heard about these Roth conversions and I started doing Roth conversions on my own and some things happened. The first thing that happened was I got this bill for my Medicare surcharges. And because I went up to the 24% bracket, now I've got to pay $314 a month times 2 for these surcharges. I wasn't expecting that. That's affecting our cash flow. That's thousands of dollars extra a year. That's affecting our cash flow. Was that the right thing to do? Then you start questioning yourself. Oh my goodness, I thought Roth conversions were a good thing to save me money over time, but now I have to pay these things immediately. Not only am I paying tax immediately, but I have this new person in my life, IRMAA, who I've got to also pay because I did these things. And I only went over, could you imagine the frustration? $306,001. And now you're over and you're in this, slot number 4 or Ed Slott probably wouldn't like that. Bracket number 4 for IRMAA, and it's $153,001 if you're single. Just for married. My gosh, that could be frustrating, right? So that's a cliff, and that just falls off. And this section here talks about the 2-year look back, so you can review that. Now, you might say, well, forget about tax planning around this. So if I'm going to have to pay all this extra money every year and pay tax on Roth conversions, is it really worth it? Well, folks, that's something you have to consider every time. Every time we embark on strategies to be tax efficient for clients, we have to see that there's potential tax savings, that we can be impactful, but we also have to look at the cost, the overall cost, the cost of IRMAA, the total effect on the standard of living. So how do you evaluate that? Well, simply this is what we do, because you can't just say, well, if I don't do Roth conversions, and why am I talking about Roth conversions? Because Roth conversions adds income, right? So if you move $100,000 a year from your tax deferred bucket to your tax free or tax advantage bucket via Roth conversion, and your modified adjusted gross income was already at $200,000, then it's likely that $100,000 would at least trigger this second. If you're married, would trigger this second bracket. If you're single, it would trigger the third bracket, right? Or even maybe the fourth at that. Yeah, certainly the fourth at that point. So you've got to be aware that Roth conversions are likely, if you're in or around age 65, it's likely to start triggering IRMAA. So ideally, of course, you learn about these things earlier and you start your Roth conversions when you're in your late to mid 50s, and you get it all done before you're 65 years old. And wouldn't that be great? I've never had anybody who said, geez, I wish I would have waited a little bit longer to do this. Everybody says, I wish I would have known about this 10 years ago. But it shouldn't stop you from considering if it's right for you. So we've learned about IRMAA, and we've learned about what triggers IRMAA. We're going to talk about this RMD effect, because that's the next thing we have to consider. Well, if we're not tax efficient and we don't do these things called Roth conversions, how can we manage this? So the way we look at it is, and this is how to potentially, I think we covered this. Who does it affect? It affects everybody who with a modified adjusted gross income over a certain amount. What is the cost? We looked at the cost. Why is this often missed? Okay, let me talk about that before we talk about planning. How you can plan to eliminate or reduce it. So why is it often missed is because first of all, with individual investors, it's not on most people's radar until they get that bill in the mail, or less, less comes out of your Social Security if you're collecting Social Security. Financial planners don't like to talk about it, and either they don't like to talk about it or they don't know, and both of those are bad situations, because it's really hard to show somebody a failed plan. It's really, really hard. And you should, as a planner, you should have methods to fix it that are sometimes uncomfortable for people. And they either follow your direction or they don't. But it's much easier to show somebody a positive plan. And we see this all the time. People come to me and they say, I've been working with my financial planner for the last 25 years, or my financial advisor for the last 25 years. And every time we look at it, he says, well, geez, you're going to have, $10 million by the time you're no longer here, and everything's going to be rosy, and you can spend whatever you want and go get that, RV or yacht or second home or what have you. But when we really dig it, and when I look at it, sometimes we see, well, you've got potential issues here. Sometimes it's you're running out of money, or you have significantly less than what you might be considering, because things like IRMAA aren't automatically calculated in some financial planning platforms. Things like out-of-pocket costs of Medicare or medical expenses after Medicare aren't automatically calculated. Higher taxes aren't automatically calculated, and actually difficult to assess in a plan. It takes a lot of work. So financial planners don't like to show. They don't like to show failed plans. They like this. They like to be positive and show you how everything's going to work out. Everything you should. We've had people we've had to ask to leave the firm because we're looking at a failed plan that we could make successful, and they weren't willing to take the steps. So that's different. Sometimes you start with a failed plan, and you can often you start with a failing plan and you make it work. But what I'm trying to say to you is that people want to show you a positive result, and sometimes they show you that by omitting certain things, either usually not intentionally, but they just may not know about it. Sometimes intentionally, or sometimes they're just very optimistic. So why is it off the mist? Individuals don't know about it. They're completely missing it in their plan, and it's just not a standard discussion in the financial planning world. True financial planners will include it, but a financial advisor who also does a financial plan, that's usually very, very surface and does not show these kind of things. So, and here's what you're here for: how to potentially minimize or eliminate IRMAA. Well, what we like to do is tax efficient planning. So moving things into Roth IRAs, sometimes cash value life insurance, and we look at the effect of that. So let me explain to you what we're looking at. Let me close this here. How are we doing with time? We're okay. So here's a comparison of one page of a spreadsheet that we use. These are internal spreadsheets that we use to see what the effect is on different strategies. So here is, client comes to us and says, okay, this is my situation now. This is what we call base facts when a client first comes to us. This is my situation now. You know what? I'm going to take me away because I'm trying to fill up the whole screen. This is my situation now. I've never heard, I haven't considered higher taxes. I haven't considered all these other issues and items that you've brought to my attention. And, my plan looks successful, but we want to make it more efficient. So this is what may happen. So in this case, this person turns 75 here. This is RMD. And this is what Ed talks about in that slide, that chart I just showed you where it said the effect of RMD. So in this case, they have no IRMAA. So no IRMAA in these years. This would have been the year that they turned 65. No IRMAA in these years. And then suddenly they start hitting their surcharges. And they start hitting the surcharges every year because of RMDs. Now, folks, do you have an option not to take your RMD? Well, other than qualified charitable distributions, no, because you're penalized if you don't take it. So that's money that must come out of your traditional IRA. Now, let me address these static charges. $10,382. Again, I'm sharing with you an internal worksheet that we have. And we made a decision not to inflate these charges because we'd have to inflate it. We'd have to just make an assumption, a guess, about the inflation numbers on IRMAA. And we'd have to make some assumptions about the inflation numbers on the tax brackets. And they're not necessarily aligned. So we start with the premise of what if nothing changes? Because if these numbers were inflated, the differences would be larger. So we say, okay, if nothing changes and everything stays the same the way it is today, as far as the IRMAA brackets and the tax brackets, because remember, it's based on modified adjusted gross income. What effect will it have? Can these steps that we're taking, Roth conversions, using cash value life insurance, if that makes sense to you, does it have a positive effect on their lifetime IRMAA, income related monthly adjustment amount, or a negative effect? And in this, we have two different plans here. So this is base facts. So the base facts is if you never attended this webinar, attended a class, met us, and you just went along with the tax deferred paradigm of putting all your money, keeping all your money in tax deferred IRAs and 401ks, what would happen absent inflating these numbers? Well, if you lived to be 95 years old, you'd pay $240,000 in extra IRMAA costs. So, and this is not inflated. So think about that in your head. Just add 3% on there. And I'll give you the exact math on that. It's a lot more than that, right? So $240,000 that most people aren't considering until it happens to them. And that's where plans can start to fail. Now, this is base facts. So this assumes you never met us. We're not doing any tax efficient planning. We're not doing any efficient and effective planning. Now, here's plan number one. We said, okay, what if we did Roth conversions, these things? Now, I want to share with you, we've reduced their IRMAA by $74,000 over their lifetime because they pay it for this period of time and they don't pay it for this period of time. So just like taxes, we're kind of front loading. So that's step number one. Well, that's not good enough for us. We're good, right? That's good. That could be a home run, $75,000. Just round it up, $75,000 plus, right? Because of inflation. Yeah, you're seeing that. But now here's plan number two. All right, what if we did other things? Now we're paying more IRMAA early in life. We're triggering it right away for these folks. Plan on it. Here's it. Bill's coming. Let's make sure you're planning on it. And they say, holy cow, you're telling us to pay more in tax right now. Now you're telling us to pay more back to the federal government because we have our Medicare expenses and now we have this thing called IRMAA. So Mark, what is the effect to us? Well, that's a savings. Well, that triggers all the way down to $89,000. And that's a savings of $151,000 plus for inflation. So a savings of $151,000 over your lifetime, folks, I think that's impactful. So with inflation, I'm sure this would be plus the $200,000. But this is an example of how you can plan for it. So how did we do it? It's right here, Roth conversions. These are principal protection. These are well, the principal protection helps on not just the investment management, but financial planning side of it too, with guaranteed lifetime income. So at this point in this example, so this is a real life plan that we happen to be working through with somebody right now. That lifetime income will come out tax free because it'll be converted to Roth by the time it's drawn out. And they also have life insurance as part of your plan. So all those things combined, using the tax bracket, it's kind of like paying your taxes earlier. You're getting this out. It's very much like that. You're getting this out of the way now. And what is the effect? And the reason we want to see this for ourselves and the reason we want to show it to the client is because, goodness gracious, you've got to be reminded and see what the difference is between these plans. So let me go back to our notes here. So I think we've hit everything here. So in this part, we've talked about the Medicare Surcharge income-related monthly adjustment amount. and what you may be missing, or maybe your other financial planner or financial advisor isn't considering. We talked about what IRMAA is. We talked about how it's calculated. We talked about who does it affect. Don't forget about your spouse. As soon as one of you passes, the IRMAA brackets are completely different. Remember, go over here to this slot report, or this slot chart. Everybody has access to this. Just go to attleborowealth.com, the slot corner. If you don't know what I'm talking about, go back to a little bit in the beginning of this video. We're going to talk, not the beginning, but maybe about that 10:40 mark. Well, you don't know what time it is when you're watching this, but and download this chart. It'll tell you everything you need to know about how, there's information about qualified charitable distributions. I didn't get to that. Other tax-free sources. If your funds are coming out tax-free from your, you got your buckets: taxable, tax deferred, tax advantage, or tax-free. Taxable, tax deferred, tax advantaged, or tax-free. Anything that comes out of here is going to add to that IRMAA category. Anything that comes out of here is going to add to that IRMAA category and calculation. Anything that comes out of here, no IRMAA, folks. Doesn't, as long as it's qualified and as long as it's coming out of a Roth or a properly structured cash value life insurance, or what we refer to as life insurance retirement plan. The only exception to something that comes out of here that doesn't apply to IRMAA is a qualified charitable distribution, right? Because it never hits your tax return. So that in a nutshell is how you position yourself so that you avoid these things like IRMAA over your lifetime. And this can be the effect, right? This sheet that I showed you here. And this, folks, is all the general information you want to know about it. You need to know about it. Implementation is a whole other area. So I think we've covered IRMAA with just about everything we can for today. If you have questions about it, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. It takes awareness and it takes planning to avoid these things. And you saw in this example that I showed you, it's $151,000 difference over this client's lifetime plus for inflation. And if you think that's meaningful for you, then you should pay attention to it and get to work on it. If you don't think it's meaningful, then you can just move on and let the government take your money in another way, like IRMAA. If you want to reach us, you can reach us to either ask questions or schedule an appointment at questions@attleborowealth.com. If you want to see where to download that chart, you go to attleborowealth.com. That's attleborowealth.com, and you go to that slot corner and download this chart and any other chart you want. That is it for today. Leighton, hey Leighton. Leighton said moving to Medicare. I guess maybe I misspoke about something, but I apologize if I did. If you haven't already, subscribe to our YouTube channel, and if you like the video, hit a like. If you and hit that notification button. So subscribe, like, and notification. And if you want to, if you got a benefit out of this, share it with your friends. Okay, that's it for today. Have a great week. Have a great Tuesday, and we'll see you next week. Take care.